Welcome to Gracefully Graying. I'm your host, Attorney Henry Gornbein. We are all aging, and today we're going to be discussing an important topic with Financial Planner Rebecca Abel as she leads us in a discussion regarding some of the financial issues that relate to our retirement, especially with our graying population. In fact, in the state of Michigan and nationally, over 50% of the population is over 50, so more and more people are reaching retirement age and beyond. Rebecca, welcome.
Thank
First
you.
of all, why don't you tell our viewers a little bit about your background and who you are?
Sure. Well, I have been a financial planner, money manager for 25 years. I'm a certified financial planner, CFP professional, and I also do quite a bit of work in divorce. I'm a certified divorce financial analyst. So I work with a lot of retirees, and one of the important things is really, looking at making sure that you have enough assets and income for the constant changing environment.
It's a good point. I mean, this week we had our air conditioning and heating checked, and as they're doing, they said, "By the way, we think you need a new air conditioner. Oh, it's going to cost you about $8,000 or $9,000." So
Oh gosh, those are never fun ones.
there's always the unexpected that happens. So how can you tell if you're financially set to retire? I mean, I'm beyond that age and I still don't know if I'm financially set, but somehow the years go by and we're living. So
Sure. Well, it's a question we always get. What's the number? There really is no one set number for everybody. It has to do with your expenses. So a client that is spending $4,000 a month is going to need a lot, a different number than somebody that's spending $8,000 a month. So it really has to do with starting with what your expenses are. And then it's also planning for contingencies like the roof, like the air conditioning, or really the most catastrophic medical costs in retirement. So it involves, complex planning. And then there's also, what your goals are. Is your goal to leave a bunch of money to charities or children? Or are you looking to, die with your last dollar? That's also a very different strategy. So it's very personal. And I recommend financial planning to figure out, are you ready for retirement?
Rebecca, what about the impact of a very unstable economy? I mean, we have tariff issues going on. We have inflation, deflation. We have a stock market that has been rising and falling rapidly. So what impact does that have on some of the plans that you do?
A huge impact. So there are studies that within the first couple years of your retirement, if we have a bad market, it's a vastly different scenario than if we're in a positive market. One of the things we do with financial planning is we run a Monte Carlo simulation that runs over 1,000 scenarios of what we've seen over the last 80 years. And then we come up with a percentage of based on these 1,000 plus trials of inflation, deflation, recession, depression, bull market, what percentage of the time are you likely to be covered for your expenses that we plan for? So we want to be at over 90% covered to know that you're ready for retirement because, we can plan on, like I said, for 1,000 different outcomes, but there are also things that we can't predict. So we're really comfortable if we can get you covered in 90% of the cases.
Rebecca, let's move to another topic, and that is housing. What are some of the housing issues that we should be cognizant of as we retire? I know I have a group of friends, and we all still live in our homes, but more and more people are moving into either downsizing or assisted living. So, what is the advice that you'd share with us with regard to housing?
Yeah. Well, having moved my own mother, and she did so towards the latter end of when she really should have moved, just physically. Um, I always recommend to be planning a few years out for this move because it's very physically challenging to pack everything. There are services that can come in and pack you, but to kind of go through everything emotionally and physically, it can be very, very difficult. And so I recommend planning it for a few years in advance, looking at, the outcomes, whether you're moving into a retirement community or just downsizing. Um, and, one of the couple reasons to do the move on the earlier side is you get rid of those unknown contingencies with certain living arrangements. If you were to move to a condo or retirement home, you no longer have those surprise roofs or problems that can come up in the home and really, dip into the retirement savings, like a roof or a furnace or, some kind of major issue that will go away in most of these downsizing outcomes where, you're moving in even to a condo that, has lower expenses. But really staying on top of emotionally and physically, when is that best time to move? And the, I know, at least with my mom, there was never going to be a good time. So it wasn't something she wanted to do, but it was something that, for many, many reasons, it made sense to do. And and it took a long, long time to plan it, to find the right place, and then to finally move. So it's not something you want to leave until you're in, dire situation where, there's some major change in health or mental capacity, because it's a lot.
So there is no good time, really. It's just a matter of, I guess, biting the bullet and doing it, for lack of a better word. Is that your advice?
Yeah, I mean, I have some clients that will stay in their home forever and have, if needed, private care come in. So it's not that it's, you have to move out of your home. There are people that will stay in their home forever, and that's fine. But if that's the case, we also need to financial plan for those continued things that will come up, and also, make sure that there's enough money for private home care if that's the goal, staying there, into your, 80s and 90s.
Rebecca, what type of investment planning do you recommend for someone who is either contemplating retirement or actually in retirement?
Sure. Well, we use an income planning approach for retirement, where we're still hoping to have some growth, but the most important thing is stable income. So we look at all income sources. We look at pensions, for instance. Some of them will have a cost of living increase, some of them will not. So we need to look at income planning with potentials for inflation and expenses, and also for variable markets. And so, for my clients, we use a combination of bonds, we use bond ladders, we use dividend paying stocks. It's great when people have pensions. Some of my clients have, substantial Social Security benefits. Social Security has in the past had a nice cost of living increase. A lot of the pensions I see at least have a couple percent increase per year, that can keep up with that inflation. But it's a mathematical formula. Again, we want to see what your expenses are. We want to plan for some kind of standard inflation rate, and then some smaller growth rate in retirement, because the investments that we're using are less growth oriented, more income oriented. So, we plug all these numbers in and also run this through this Monte Carlo scenario that factors in different inflation, stagflation, deflation rates, just to see that we're okay. But the investing approach is different once you're actively drawing down income from investments.
So how does it differ?
Well, during the accumulation years, we might have a heavier focus on growth investments, and less of a focus on income investments like bonds or dividend paying stocks. And so as we get closer to retirement, we'll shift down the risk in the portfolio and pivot towards more heavily being weighted in investments that generate income versus aiming for growth.
Rebecca, what about tax planning? And, as we're speaking here right now, there's possible legislation that is saying, if it passes, and who knows if it'll pass, is that Social Security benefits will no longer be taxed, which will be a boon for those on Social Security, but there are going to be a lot of other loopholes and issues. So what is the tax planning that you recommend for those who are either going into retirement or actually retired?
Yeah. Well, tax planning is a critical step. You can end up saving a lot of money if you plan carefully on from a tax perspective. So I look at something called the tax control triangle because there's three different ways that your money can be taxed. Start with the most cost effective, which is tax free investments, and that's money that would be in, for instance, a Roth IRA that the money that grows, even the income that's produced, is tax free forever. The other big pocket of tax free money is actually the proceeds from the sale of a house. And so you purchase a house. Let's say you purchase for 250,000 and you're a couple, you have up to $500,000 of gains that when you sell your house can be tax free. If you're a single person, it's 250,000. So that's a big pool of money that in retirement, you sell your house, you have this new pool that you received all the growth on tax free. And then obviously that needs to be invested and won't stay in that tax free tax shelter. Um, so there's tax free, then there's tax deferred, things like a 401k, an IRA, different defined benefit plans that you have not paid taxes on this money, but when you go to pull from it, you're going to pay full ordinary income taxes on it, just as if you were still working. So you're still going to pay state and federal taxes, and depending on how much that is, it can really be a substantial amount. So I have some clients that have been phenomenal savers and have quite a bit in tax deferred investments, so much so that when they are in retirement and they hit age 73 and they're forced to take out this amount every year called a required minimum distribution, their tax bracket actually goes up. They weren't spenders during their working years. And then, let's say they have 2-3 million in a 401k or an IRA. When they are forced to take out that amount, let's say it's 150,000, that might end up being more taxable income than they had during retirement. So where tax planning comes in there is we might not want to wait until 73 to be forced to take out this lump sum every year. We might bump up our distributions just so we are transferring that money from an all tax deferred pot to the third category of the tax control triangle, which is a taxable pot. So the taxable pot is where you have money that you're being taxed on income and capital gains. So when you sell an investment that you bought for 1,000, it's now worth 10,000. You're going to pay a 15 or 20% tax on that growth, but that can be less than the tax of ordinary income, which is, again, like you earned it as a paycheck. So we want to balance those three. There's also some opportunities in retirement for Roth conversions, just depending on the situation. So, I've had some clients recently. I had one that retired last year and had a lot of cash to live on. She didn't plan on taking withdrawals out from her 401k for a while. So her income was very low. And she was living off of a cash buyout, which was not going to be taxable because it was just money that was, sitting in a checking account for the first 2 years. So she was a great candidate for a Roth conversion IRA because her tax bracket was so low. And she had this kind of, not going to call it a ticking time bomb, if it was a 401k that had a large value. So she had over $2 million in it and she was only 64. So where it's a problem is if all of a sudden that 2 million becomes 4 million in 10 years, when she goes to pull out the required minimum distributions, that's going to push her into a really high tax bracket. 4 million in a 401k or IRA is a very large required minimum distribution that, it might make sense to put some money in, pull some money out for distributions earlier, or do some Roth conversions where that's you're not taking the money out technically to spend it, but you're paying the taxes on it and converting it to this Roth conversion IRA where now it will be tax free forever.
Rebecca, for those of you, our viewers who are not sophisticated, explain the difference between a regular IRA and a Roth IRA, Roth conversion IRA.
So there's a traditional IRA, which is money that was saved pre-tax. So, you earned it from an employer, it went into some kind of retirement plan, or you just saved it individually into a retirement IRA. And that money is, as long as it's accumulating, is tax deferred. And then when you go to pull the money out, you're going to pay that ordinary income tax of federal and state taxes on that money of, whatever your end up ending up tax bracket ends up being. Whereas the Roth or a Roth conversion account, once that money's in there, it's tax-free forever. So you don't have to take out a required minimum distribution. You don't have to pay taxes when you withdraw from it. And so it's a nice little loophole that the government, while you're accumulating, allows you to put $7,000 or $8,000 if you're over 50 into this tax-free place. But for the sake of a Roth conversion, you can convert as much as you want from a traditional IRA or even a 401k into this Roth IRA. You have to pay taxes like you earned it then. But again, once it's in a Roth, it's never taxed again, and there are no required minimum distributions. So it's tax-free versus completely taxable at the highest, at ordinary income rates, which tend to be higher than capital gains.
So basically, a Roth is one where you've already paid the taxes on the money. It goes into the Roth IRA, and then as the interest and accumulation grows, it's tax-free forever. Is that a correct explanation?
It is. So it's a great investment strategy, because if you're eliminating taxes forever on growth, there's nothing better than that.
Let's go to estate planning. And what are some estate planning tips that you can provide for our viewers?
Yeah. Well, the first and most important is have an estate plan. So many clients come to me without any kind of estate plan, without a will, a trust, power of attorneys for medical and financial. So having an estate plan is critical. It will make things so much easier for your family if something were to happen. And really deciding, who that person's going to be, your people that will be handling your finances or making medical decisions for you before those issues come up. And then further in estate planning, there are some things that we can do from a financial and tax perspective to reduce taxes and just make things more efficient. So it's something that you want to be doing even as a 40-year-old. Estate planning is an important part of financial planning that you don't want to miss, but especially as you get older. And these powers of attorney can be really important and really, really help a family having to step in and help somebody medically or financially. Without those documents, it makes it much harder.
It's so appropriate. I mean, I can't recommend too highly the importance of not only a will, but also trust instruments, powers of attorney, also medical designations. I mean, certain things Rebecca is saying is that, if you have a critical illness, do you want to do not resuscitate? Do you want everything done medically to save you, or do you want to be let go and be allowed to pass away peacefully? So these are all things that can be done through a good estate plan. It's so important. And as Rebecca says, this is something that too many people do not have. I mean, it's amazing. A lot of celebrities have died without estate plans. I mean, Elvis, for example, I think Michael Jackson. It's amazing how many people don't have them. So again, Rebecca is giving some very sound advice. Let's go to another area, Rebecca, and that is, what about long-term care and health care and retirement?
Sure. Well, long-term care is one of those expenses. If you were to need somebody to come in the home and provide regular care going into a facility, they can be expensive. So the care can be over $100,000 annually as an additional expense, depending on how much is needed. And so there are different ways to help offset some of these costs. One is traditional long-term care insurance. Now, I have gotten away from using traditional long-term care insurance over the last decade because one of the issues with the policies are, they're very expensive, especially if you secure the coverage in your 60s or 70s. Another is it's very difficult to get. So things like anxiety, depression, any family history of dementia, those can make you ineligible for the coverage. But the biggest issue I've seen with these policies, even if you are able to get them, is that they have what's called a guaranteed renewable but non-cancelable structure, where the policy, they can't cancel on you, but they can raise the premium as much as they see fit to cover the claims of their company. So claims have been extremely high over the past decade, and these policies, I've seen people's premiums go up 100% over 10 years because of the ability of the insurance company to say, okay, our claims are way up. We have to increase this premium in order to cover our expenses and maintain some profitability. So that's been a major challenge in the industry as a whole, the long-term care insurance industry. What I've seen as a more successful strategy now are there life insurance policies that you can purchase that have a long-term care rider. So I've seen where you can have a $500,000 permanent life insurance policy, which actually helps some estate planning needs, because when that policy transfers, a death to the beneficiaries, that's a tax-free from a federal and state perspective lump sum that they'll receive. But you can add these riders that allow up to 90% of the death benefit being able to be used for long-term care expenses. So that to me kills a few more birds with one stone. It doesn't have this potential for astronomical premium increases during retirement. And then the third avenue is to self-insure. So I have some clients that are in a position that they have enough money based on their expenses, because this is all, if somebody has $5 million, but their expenses are 20 grand a month, that's very different than if somebody has $5 million and their expenses are, $6,000 a month. So if we can see that somebody has the ability to self-insure based on a potential long-term care need, we put in some expense there and do some financial calculations. And that's obviously an option too. And it really just kind of depends on somebody's risk tolerance and their interest for passing money on to a family member or charity. And so it's all very personal planning, but we are definitely not using the long-term care traditional insurance that we used, 10 plus years ago, because I've just had a bad experience with that, with the premium increases.
Interesting. I happen to have long-term care insurance, and you have options. And first of all, it's almost impossible to get it. It's very rare now, and what Rebecca is saying is absolutely correct. And also, they can keep increasing the premium. So what you have is almost a Hobson's choice, where number one, you either pay more premiums and they're adjusted every year, every couple of years, or else you can agree to keep the premiums the same level, but lower the amount of the benefits. So there are pros and cons to it, but Rebecca is giving some very sound advice. The other thing is that long-term health care and the premiums on health insurance is going up continually, as well as the fact that if you need to live in an assisted living or nursing home facility, the cost can be astronomical. You're talking about anywhere from $6,000 to $10,000 or more a month easily. So these are important points, and Rebecca is giving some very sound advice on these issues. The next topic, Rebecca, how can we maximize our pensions?
Sure. Well, pension maximization is a strategy for people that have structured pensions from an employer. And what those typically look like, and this is for a married couple, is that the spouse that has the pension has the option at retirement to pass on funds to their spouse when they die. So there's usually like 100% survivor pension. So let's say you're getting $3,000 a month, the 100% would also pay your spouse $3,000 a month when you die. There's 75% options, 50. I've seen it go down to 25. So what the pension maximization strategy is instead of taking a full pension with a survivor benefit, you take the full pension without the survivor benefit, and then get a life insurance policy that would be in place to generate that missing income. Now, these only work when the difference between the full and the survivor pension is around the same amount as the life insurance premium. They can work, even if it's a bit above, because again, with these life insurance policies, you can tap on long-term care benefits, and you do have some other benefits, the tax-free benefit of life insurance. But yeah, with these long-term care riders, it can be a really good overall strategy. But the nice thing about having a pension max strategy where you're taking your full survivor pension and not, because if you take a full a spousal benefit, and let's say your full survivor was $3,000, to get the spousal benefit, you might drop down to $2,500 a month. So that you're getting $2,500 instead of the $3,000, but with the guarantee that your spouse is also going to get the $2,500 into the retirement. This gives you that higher income. You take the $500 difference, you buy a life insurance policy with it. Now, when both spouses pass away, ideally there's some money left in that death benefit, because with a spousal pension, when the second person dies, that money is gone. It doesn't continue paying out to family members. So I often, will run the numbers to see if these work. Now, I've seen some cases where there's a very, very little reduction between a full and survivor benefit. Let's say it's $3,000 and for only $200 a month, you have your spouse that can get paid, so you're both now at $2,800 versus, I originally said a number for $500. So it's very custom, that we have to look at what those different numbers look like. And I've seen very successful pension maximization strategies where it's now, you have this life insurance policy that continues paying for the spousal benefit once the primary person with the pension dies, and then they have this big lump sum. They can get the long-term care rider on it. So it can accomplish many different things, and it's definitely a worthwhile thing to look into depending on the overall situation and insurability of the person with the pension, because if somebody's already sick, that strategy won't work.
You're providing a lot of important strategies for those of us who are aging, for those who are contemplating retirement, or for those who are actually in retirement. What are some other thoughts that you can share with us before we sign off, Rebecca?
Sure. Well, don't sweep it under the rug. This is something that needs to be addressed. The estate planning, the income planning. You don't want to look at this too late. I start planning with clients in their 20s and 30s. That's obviously great, but if you're in your 50s or 60s, or even several years in your 40s, it's great to start planning early, and to start thinking about what this might look like. A lot of people in their 40s don't know, oh, I want to move to Arizona, or I want to do this, and that. But at that point, it's about accumulation, and accumulation to set yourself up from a tax perspective in the most beneficial way. But early and careful planning, and really especially facing estate planning, can really save a lot of time, money, and family headaches. So this is something to be proactive on. And it's important to have a certified financial planner when you're looking at these numbers, because that's really, the advanced degree, the advanced training in knowing, how to plan for these kind of retirement issues. There are also some other retirement specific designations, but it's important that the person that you're planning with has the experience and expertise to be able to give the good advice.
Rebecca, how can someone reach you? What is your company and your website and phone number?
Sure. Well, our company is called Oak Point Investment Partners. So check us out on the web at oakpointip.com, and it has all of our contact information. Or you can reach me at rebecca.abel, ABEL, at oakpointip.com. I'm happy to chat with you.
Rebecca, thank you so much for some excellent advice for those of us who are gracefully graying or even beyond that point. And I want to thank you for being our guest on Gracefully Graying, Rebecca Abel, financial planner. And I also want to thank our viewers and our sponsors for making Gracefully Graying possible. And of course, Bloomfield Cablevision. Thank you.